Okay, a back spread on oil, or excuse me, a risk reversal on oil. So let's go look at USO. USO right now is way down. It's dropped. It's got slowing momentum. There was a huge spike in volume down here, but that's just before it dropped. And we're looking at it just slowing down into this. Overall, if you take a look at crude/CL, let's get candlesticks on drawings. And I hate the charts in here. Hate them. I mean, they're awesome for options, but they suck balls at charting. Okay, let's see. Let's go in here and get chart types, candlesticks. Okay, so we've made a pullback. It hasn't dropped as much. The problem is against the dollar. Now, I think the dollar is coming unhinged from this. This has no commodities in it. Dollar's going up, but it's slowing down. I was a little worried about that, but we're going to go out a few months. We're going to come in here. We're going to go to USO, which is oil. We're going to go down out to January or February. Let's take February. By February, if we look at all strikes, we need to get all strikes on setup. There it is, right here, all strikes. Okay, so what we're going to do is we're going to go 5 strike prices out of the money. 1, 2, 3, 4, 5. That's 124. 1, 2, 3, 4, 5. It's even. It's about even Steven for puts to calls. That means there's no strong bias in direction on oil prices. But what we're going to do is we're going to sell the $31 and we'll sell 3 puts, not 10, -3. So we got to fix that right away. So we go into setup, we go to application settings, we go into order defaults. That's good for stocks, 100, but 1 for options. Futures is 1. Futures options is 1. And Forex we're not going to do through here. So we're going to click OK. All right. So we sell we're going to sell 3 puts and buy 3 calls. Now, typically what we're going to do is we're going to pull up USO and we're just going to look for a seasonal play. We're going to go to studies, add study, Bollinger Bands. Okay. Bollinger Bands, simple. Okay. Now, the probability of getting to the middle of the band, even this month, is pretty high, which is 32. So we're going to come back in here and we're going to look at our trade at 32.50. See, we can only sell it at 195. I'd like to be able to double that. I can't, so this will be a small credit. This is called a synthetic long. We're going to go 1-to-1 relationship, or I could sell in the money. So I'm going to get $1.96 for selling this, and it's going to cost me at 32 $1.95. So I'm going to buy 3. This is actually a synthetic long. We won't be able to do a risk reversal. We can't get enough for it. So we're going to analyze this trade. This just shows there's a flat spot. I won't lose if it drops down to 37. 30, that's 32. Now the way we can see that, let's double check that. That's 30 bucks, 31 bucks. If I go in here to price slice, you go to add slices, you go to 31 bucks. 31 bucks will be down 117 today, but not at expiration. Okay, this is today, 117 at 31 bucks. This red line is expiration. So right now we have a live. We're going to put the middle one live. This is the current price. And then we're going to go up 1 ATR, which is about $1. We're going to go up if it rises $1, or go down here if it drops $1. Okay, this is how much will be affected. We'll make 273 on the way up, 281 on the way down. This is a very conservative trade. We're going to send this in, but we're not going to have any stops and targets because we want delivery of this. We want to take delivery of the, meaning if they put to us, so what? If it does run up 1 bar, we could do this. This is one way I do it. We won't get enough out of it to do it quite this way. So let's say it runs up 2 bars. I'm going to come in here and I'm going to look at add a simulated trade. I'm going to go in. We're looking at right here, February's. If it runs up $2, we're going to change this and look at it. We're going to see what would happen if we buy back the put. So do you see where this says 97? We click on the ask. We have 3 of them. 1, 2, 3. We're going to buy those if it runs up. Now, if it runs up $2, $2. Oh, it won't let me do it there. So let's go back in. Let's go to dollar step, $2. We'll be down on a put. Now, we're selling it to open, so we'll actually make 230 bucks. That's acceptable. So it's $2 up. We're at 31, 32, 33, 40. So what I'm going to do is I'm going to go back over here to trade. There's a lot to this. There's a lot to it. So let's go up here. I want to shrink this up, and then we're going to come down into this little bracket right here where it says trade, and we're going to go to we're going to first triggers OCO. This is the first order. This order triggers something we're going to do in the future, and we're just going to get in for a 14-cent credit. I'm going to go back to analyze. I'm going to right click, and I'm going to create a duplicate order. This is the buy these 3, and I'm going to go GTC good till cancel, buy it at market. If it goes at or above, and we're going to say 30 to 33 bucks. If it gets above 33 bucks, close the puts. When we do that, we're going to look at it, and we're going to probably sell some calls against it. This would be typical of what I would do. I'm going to go in here, and I'm going to pop down right into the February ones. I'm going to come back to my trade right here, or to analyze. This is where the analyze is. I'm going to go back to analyze, and I'm going to bring this back up. Now this one, there's a lot to this. This is the original order. If it runs up, we will make 200 bucks, but I want to look at it on just one contract. So if it does run up, we're going to make $73. So this will be worth about $120. Okay, that's what we'll be paying to buy it back. Okay, but we had 3 of those. 1, 2, 3. Okay, 1, 2, 3. Now, where that's 120, we're still going to be at risk 327 bucks. So to control that risk, I'm going to come in here and I'm going to sell some calls once it jumps up. And if you notice, I own the 32, so I'm going to sell 133 for February. I'm going to show all of these. So I'm going to sell 133, which is below me. It'll be maybe in the money by then. And let's see, was that a 33? 31. So we're going to change this to a 31. Okay. We'll change this to a 31. All right. So we want to change this to a 31. Okay. So if we do this, we want to know the prices of these when it goes up. So what we're going to do is we want to see what the price of this would be when it goes up $2. Well, if there's a $2 rise on this, this one's going to be worth $1.54 more. It's showing a loss there, so instead of 207, it'll be worth 357. And if this one runs up, let's uncheck it, and we're going to sell it. It won't be worth. It'll be worth $1 more, so 242. Yep, we'll have controlled our risk nicely. So this is what happens if it runs up. Okay, we will be at risk-free in a $2 move. A $2 move will lock in 285 and have an open-ended risk graph. To accomplish this, I'm going to right-click and I'm going to go to, well, let's do it from here. We're going to go to the Trade Center. We're going to come down here and I'm going to hold down the Control key and I'm going to go into February. And what I'm going to do is I'm going to sell a 32 when it gets, nope, we own the $32 calls. So I'm going to sell a 31. I'm going to hold down the Control key, click on the bid of the 31. I'm going to hold down the Control key again and hit the bid of the 33. That's called an inverted, well, it's kind of like an inverted butterfly. That's the trade that I've got on, okay? Now, if it trades at or above 33, I'll close this out. Otherwise, I'll buy 300 shares of oil. Okay, that's one trade. Done.